Avoid death by taxes. Now, obviously, I said before that the wealth is money that you get to keep, not what you give it to ATO, really. And the more you get to keep, the faster you will be able to sort of accurate your wealth creation. Now, I always say that a lot of people will be happy to pay taxes. You know, they'll be happy to trade places with you if you pay taxes, because that really means you're alive and kicking. But it's really stupid to pay $1 more than you need to. And you need a lot of planning and all that for that. Because the money is better. Does anyone agree that money is better in your pocket than in ATO's pocket?
Yes, absolutely.
Correct? Very good. Now, again, we have said before that wealth is money that you get to keep, not what you spend or what you just earn. And the more you obviously save, the more you will be able to, from taxes, the more faster you will be able to grow your wealth. So effective tax strategy, actually, believe it or not, is really a must. And we will show with some examples in terms of your wealth creation. So I normally tell my clients, jokingly, there are two things certain to happen in our lives, death and taxes. And a good accountant or even a half a decent accountant can actually help you with one of these, but not the other one, So you have actually a right to arrange your financial affairs in a manner that saves you tax. Carrie Packer once famously said, a Senate committee, that anyone who doesn't do anything to save their taxes are idiots, because your government doesn't spend it that well anyway. So learn from what he said. So before I want to go on further, I want to talk about something that I get asked very often: positive gearing or a negative gearing. There is a lot of misinformation out there. Just this morning I was watching an ad by a property guru, basically saying there, invest in property and save taxes, invest in property and save taxes, invest $1 million and save some $20,000 in tax or $5,000 in tax or whatever it is. Bad idea. You must understand what is negative gearing. Negative gearing basically is you are trying to lose $1 to save 30 cents or 40 cents. Why would you do that? Why would you do that? You will get some tax back, but overall you are making a loss. And I'll put it in your folder as well. So negative gearing is when you take a rental property and you keep the mortgage interest very high, and with the mortgage is so high that you are actually making a loss, and you are able to write off the loss against your salary income or other income, so you are able to get a bit of a tax refund back. But ultimately you are still making a loss to save that little bit of those cents. And second, you are actually taking that property in your own name, so you are exposed to the asset protection risk. And Neil is going to tell you that you are better off actually investing in properties that are high in cash flow. You see what happens when you take a negatively geared property? The interest rates go up, you are stopped. A lot of people have to sell their properties because they cannot keep up anymore. Or the property prices fall or the bank foreclose, it becomes very difficult. It's a bad strategy. Why does it happen? Even a lot of accountants recommend that. Why does that happen? The fundamental mistake in this strategy is you are letting your investment strategy being guided by your tax strategy. You see, your investment strategy must be guided by one and only one thing: return on investment. Am I going to be making money on it month to month, year to year? And will I be making good money on it when I sell it? And how much that will be for me to be happy to invest in that? You do not go on to $500,000 or $1 million or $2 million investments to be guided by your tax strategy. It's absolutely crazy. All that is happening is some accountant has helped you because you have saved some tax, or property guru has sold you some properties, but you are not really benefiting in the long run, definitely not. And Neil will tell you a lot of options in terms of how high cash flow properties can really accelerate your wealth creation. Tax planning strategies. Now, we will not have sort of time to go into it in details, but I've just listed here 10, 15 tax planning strategies, and a lot of them probably you can very easily implemented. But I'm just going to touch upon a few. Has anyone heard of bucket companies? Yeah? So how the bucket companies work is that if you have a trust and you are able to, in the trust, because of that, in a high cash flow property, stream that income to members in your family on a lower tax bracket. Let's say you haven't got any, or you have sort of hit the cap, you've distributed to everyone, there's still money left. So what you do is open up a company, make it the beneficiary in your trust, and just distribute it to that company. So if you're at a 50% or a 49% tax bracket, you still pay tax at a 30%. And you are still saving 90% tax, and in some of the cases that can be huge. Spouse contributions, probably I think one of them, Cornell will be touching upon it later on. Use of structures. There's no need to invest every time, every property in your name or in your husband and wife name. You can use structures. So what is income splitting is you channel that income into your family through trust or some other structures, so that if you have adult children or a lower income earning spouse, you are able to transfer that income to them. So effectively you are not taxed at your top rate, you are taxed at this rate there, and I'll show you a case study later on, and you will see what a huge difference it can make.
But is this applicable to the salaried employees? Because our ATUs,
No, not everything is applicable to salaried employees, but yes, if you could be investing, for example, in properties, or in business, or in shares, or any other investment you're doing, where you're really getting good income in, this is where you can do that, So not salaried, but salaried people can also have spouse contribution to super salary packaging and novated lease. How many people use car for their business or for their work purpose? So you can get it novated. You can get it novated, or you can get your company to pay it. So even though you will be paying for that, they will be making a deduction from your salary. But the way it works is that they will be making a deduction from your pre-tax dollars. So just to give you an example, very rough thumb rule guide, if you are earning 90,000 plus and you are about 15,000 kilometers or so, you are doing that, but you will easily save 4,000 to 5,000 in tax by employing this strategy. It's just a matter of asking your employer, can I salary sacrifice? Can I novate my car with you? Can I novate my phone with you? Can I novate this and that with you? And it will make a big difference. I mean, $4,000 or $5,000. I mean, I've seen people saving up to $12,000 as well in tax by doing this. Especially people, obviously, the higher your salary, higher your tax bracket, the more and higher your kilometers or business use, the more you will save. So just some bit of these things. So I can't. I'll show you an example later on. Okay, now here it is the case study. Now this is actually the case study of someone who was referred to me. He was doing a 3-unit subdivision. It was somewhere in Parkwood, $1.2 million investment, and he had budgeted to make $240,000 in terms of profit. He had even set up a company to make that, and the offer was presented, and the offer was accepted. Now, obviously, the tax was not taken into consideration anywhere. It was just that spur of the moment. There's a good opportunity. You set up a company, you talk to someone, you do the budget and all that. It makes sense. You invest. Now, GST was not factored into. On residential subdivisions and all that, there is GST applicable. You may not know, even though you think it is a house, but there is GST applicable. Company is not eligible to a 50% discount, a capital gains discount. That was not factored into. No income splitting, because the spouse of this person was on a much lower tax bracket. That was not factored into. It was just a company, and he was a sole shareholder, and his shares were in his name, so he was exposed. So after aligning all those things, so this was the before tax planning, he would have got of $240,000, he would have got only $76,500 in his pocket. And 150 would have gone to ATO in terms of income tax and GST. What do you think about that? Working hard, taking a $1.5 million risk, only to make ATO a 2/3 partner in your profit and hard work, without them even lifting a finger. Now, we got it changed from a company to a trust, and if he would have just sold it straight away after that, he would have still saved $30,000. And if he could have, let's say for 12 months, which in his case he could have, no one just advised him, but he could have built for rent, after that he could have sold it, he would save $131,000 in tax. How much is $131,000 in tax savings?
Yes.
Imagine what you can do with your money.
Yes, salary.
What can you do with 131,000?
Lots. Take the year off.
Sandeep Singh, I know he would like to buy a golf course, but that's a lot of money. And the reason I picked up this example is that nowhere this phenomena of death by taxes is more apparent or happening or more at risk than in residential property development. And what is the reason to avoid that? That when you make an investment or you do things, you must always talk to your accountant and plan those things for due diligence, for taxes and everything before you make a decision. Once you have made a decision, you're locked into the consequences. You have no option but to go through it. Does it make sense? Any questions so far? Yeah?
Will we be getting a copy of the slides by any chance?
I can send you if you want, but there is some information in there. But I'm more than happy to send you a copy of the slides and other presentations. I'm sure they'll be happy to send a copy of their slides to your email. That's fine. But any question on it so far before we go on to the next one?
You mentioned about the bucket companies.
Yeah.
Now, does the bucket company needs to be doing some transactions as well, or you just?
If it is doing some transactions and doing some business, the only difference is then you pay tax at 25%.
Yeah.
But if it is not doing anything and if it's just a bucket company, then which means that it is a non-base rate entity, then you pay tax at 30%. That is the only difference. So difference is only 5% in tax, but yes, no, it doesn't need to be doing.
So no questions asked about why the company is dormant? And
No,
not
you see,
doing
they
it?
try to understand.
Yeah.
ATO cannot question your business decision.
Fair enough. Yeah.
So that is your business decision. And if you can say that I'm doing it because it gives me better asset protection, that's a very legitimate, fair income reason. ATO cannot question that. And if that leads to lower tax, fair enough. But if you do something that hasn't got any business rationale in there and you are just doing it to save tax, then that is tax avoidance. So
on the bucket company, the money parked in the bucket company, can you reinvest that back into the property?
you can reinvest that. The problem is if you take the money back, then again you will be taxed at your rate. So you have to keep then reinvesting the money from the bucket company, but you're better off doing that than paying a higher rate of tax.
What if the company itself wants to invest that into property?
You can.
Okay.
You can. Definitely you can. So the moral of the story is that whenever you are carrying on any investments or any undertaking or any wealth creation activity, anything that will give you income, do your due diligence, not only just do on your due diligence on return on investment after tax, not before tax. Because before tax, it could be saying you are making good decent bit of a profit, and after tax, ATO takes the money and it's that much. So take all taxes, everything into consideration and talk to your accountant or tax advisor before, not after.